And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Good morning. Welcome to Financial Fitness Friday. I'm Rich Rosso, certified financial planner, here with Danny Ratliff, certified financial planner squared. We're happy you're with us. Futures are down this morning. Things have been a little turbulent. Danny, I think as the Fed keeps pounding into the market and these numbers seem to be better than usual and inflation might be a little bit more stubborn than usual, markets might be in the mode of good news is bad news.
Yeah, and
right?
that's not uncommon in this environment. I mean, looking
Right.
at what they're trying to do, anytime that we're getting better economic data than anticipated, and I use that word better probably a little too loosely in the sense that, you know, obviously inflation, that's not necessarily great in this environment with this much inflation.
Well, it is, and you have a lot of Fed representatives that were saying we should have gone 50 basis
James
points.
Bullard, yeah, he's out now saying that he can't rule out a 50 basis point hike in March. And honestly, the Tuesday before this last meeting, the market ran Monday and Tuesday. I thought, oh man, I think they're going to shock the market. Maybe they should have.
I think they should have. It's persistent. Obviously, we could say, I hate to say it, some of the product inflation is transitory to some degree. Although embedded in the PPI, the cost of goods, if you look at the product, if you look at some of the costs of product, those are also still higher. So even some of the inflation when it comes to products, goods, is still there. But obviously, this is really a service inflation issue. And I think, Danny, and we talk to so many small, mid-sized businesses, this inflation is going to be a tough one to crack, especially with the way the labor force participation rate is and where unemployment is. So the blunt hammer that the Fed is using, they're going to have to keep pounding. And I think there's some talk where you're going to see short-term rates well exceed 5.5%. I've heard some pundits yesterday talking about closer to 6. So I don't know what the magic number is, but that service inflation is well embedded until there's a change in the labor force and how we work.
Yeah, I think you're right. It's going to be a lot more stubborn than people anticipate. And, you know, it is transitory. So let's be real. It's always transitory.
Everything's transitory.
It's always moving.
It is
However,
always.
it's just moving way slower than what they anticipated or they wanted. And that's the problem.
Well, because they want to be observant and they see certain numbers. But if you go to the Atlanta Fed, you look at the wage tracker, you look at the sticky price index, those prices on the sticky prices, they haven't really moved. They have been very sticky, and those prices need to come down. Those are longer term kind of issues with wages and rents. And I understand that there's a lot of contractual inflation that'll eventually go away. But, you know, I'm even starting to see housing market improve as interest rates have come down. So I don't know. I think for the market, it's going to be dangerous. I think this front loading we've had, I think we're going to lose most of this rally. Interestingly enough, you know, international investments really came out of the gate strong, but then when you look at it, U.S. is still ruling the roost.
Yeah.
So it was interesting to see that U.S. stocks have beaten the FTSE World Index by 5%. That's this was going to be maybe the year of international, and I thought so myself, but it seems like USA
Yeah,
is still where it's going. So
well, it's interesting. You know, you heard all the dynamic. I think everybody comes out with these what do you want to call them? Cute words. It's a slow session. It's just really slow.
we come up with a good one. We called it the muck session.
Yeah, we're in the muck. Well, and I saw one yesterday, or maybe it was this morning. I can't remember. Talking about it's the rich session. The rich are being hit. I'm like, wait a second. That's not really a fair assessment, because You look at the average consumer, savings rates have declined substantially. You look at credit card balances up. I mean, all the things we've talked about.
Yeah.
And I think that the lower end is really getting crunched. And I don't know that we're accounting for that enough, because you think about it. You've spent down all the funds that you had.
Yeah.
All the stimulus money is gone.
That's right. And now you're on credit cards, right?
And you're on credit cards, which with higher debt, higher credit interest. So your profit margins and your household are decreasing. Not to mention things are just much more expensive. I think people are getting hurt a lot more than what we're being told, or what we're seeing at least.
Maybe they're saying this from an employment perspective, because Danny, we've been talking about this, that if it's going to be contraction,
it's more of the white collar jobs.
It's going to be more the white collar, right?
Correct.
Because if you're the guy working in the restaurant, the way restaurant spending, when you look at the CPI, look at food away from home. I mean, these components of dining and leisure are still very, very strong. So maybe that's what they're talking about, is if you're working as a client-facing individual at a service business, they're most likely desperate to keep you. You're probably not going to lose your job. But if you're some middle manager or some white collar, and listen, we see it in Silicon Valley. Now, I'm not crying any tears. These are high qualified people. They'll find other jobs. But
they are. That's the kicker.
Yeah.
They're all finding other jobs, and they're doing so quickly. So for a smaller business in those areas, we have a client who lives out there and a CEO of a startup, and he's like, man, this is great. He said, the issue is everybody who gets laid off finds a job quickly. It's good for the little guys.
Yeah, but to the stock market, jobs are bad. Low unemployment, people working is not a good thing. And we understand, and we always say it. You don't fight the Fed.
Well, we have to remember those companies as well, though. They were also hiring like crazy during the pandemic, because what was everybody doing? All these tech companies, how do they want to get their information out? What were they doing to bolster their workforce in an environment that they could take advantage of? And they did. Mm-hmm. So they may have been a little top heavy from a headcount perspective.
Yeah, well, you see it in financial firms, right? Some financial firms are reducing headcount. And Goldman Sachs stopped their coffee service. All their fancy coffee service. So when you walk into work,
they got a coffee service?
I'm so sorry for you.
What does that look like?
It's a cart.
My coffee's made at home out of a pot. We're not doing something right. We're not living right, Rich.
Before you walk into Goldman's office in New York, they have and New York is full of food carts and coffee carts, but this one is exclusively for the Goldman employees. And they have a golden cart, and you're able to get your coffee before you get into the office.
So does somebody make this for you, or is it just one of those?
No, it's someone's there serving you.
You got your own personal barista?
Yes.
It's a Goldman barista.
It's a Goldman barista. And
That's
now,
fancy.
there's no more.
I like it, though.
You can't have it. It's so tough out there. You're going to cry like a little girl if you don't get someone else to make you coffee. So we are seeing maybe this rich session kind of thing that I've got to find that article. That sounds like an interesting perspective, but we talk about it all the time. Maybe that's what it is, but there's all kinds of names for it. It's muck. It's mucky. It's all mucked up. We get back, there's some cute thing I'm supposed to say about it. Don't fall behind in retirement and look forward or whatever. But Brent will cue me in later. When we return here on Financial Fitness Friday, stay tuned.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We teach our kids the alphabet and all the colors too. But raising our kids to be money smart is really up to you. Our next RIA Lunch and Learn will dwell upon this topic, because teaching kids to manage their coins puts money in their pockets. Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, Danny, I think we know each other long enough where I can ask you this question.
Oh, my.
How are your underwear?
What?
They're good. Why?
Do you realize that Alan Greenspan used to use men's underwear as an economic bellwether, right? So the theory was that underwear was a necessity. Now, today, I don't think it is, right? Because you had all this fancy underwear. You got Tommy Johns and Boo 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 and all this kind of stuff. But when there's economic anxiety, men will not replace their underwear that's already in their drawer, right? So it causes sales to dip. So he would actually wait for the economy to bounce back before you invest in a new pair of underwear. I will tell you, in some houses, there's been an ongoing recession for probably Brent's house since 1975. But so Greenspan had all these indicators. I don't think that would work today. I don't think we could have an underwear.
Well, it depends on who you are, right? Like for me, it's not a want, it's a need.
Well, he said it's a necessity. It's a necessity, but you might get holes in it. The elastics.
I think men are probably more likely to say, "Yeah, well, we overlook a hole."
I think men will do that regardless of the economy. Don't
That's
you?
what I'm thinking. Yeah. Like, I buy them when I absolutely need them because...
Me too. Like, if you're cheap, not even cheap, but good with your money. But,
dude, I actually had to. We've talked about this. I had to buy some new underwear. And you're right. It is ridiculous.
You see the price of underwear?
Somebody said something about welding. Hell, I'm taking up knitting.
Well, you got, like, Tommy John and all these fancy underwear. And I just go right for the Fruit of the Loom, which is trying to copy Tommy John.
Yeah.
But it's just not as, it's not the same price.
You could rig up a loom in your garage, Danny.
You could.
And
start weaving it yourself.
Yeah.
It's not a bad idea.
The Underwear Indicator.
So if you look at the sales of male underpants, it's been, how can it not be more than just a flat line and then maybe it beeps up once in a while, right?
But you bring up a good point,
But there are occasions when it does dip, and
Yeah.
then they say that the economy is going into a pants session, underpants session.
So what is it right now?
Well, I don't know.
Oh, I thought you had some...
No, I don't have the underwear index, but we have to see.
All right, I'm going to find
It
this
fell in
before the end of the show.
2008 and 9, I will tell you that.
Uh-huh.
Like men's underwear looked like Swiss cheese probably during 2008 and 9.
Compliance tech department. I'm actually nervous what's going to come up when I start Googling
underwear.
Yeah.
Yeah.
Men's underwear.
What?
Tommy John.
Yeah. Yeah.
So I'm just
Maybe I
saying is
won't.
that
I'll let you
there's
do it,
all
Rich.
these funny.
They're used to your
there's all these
browser
indicators.
history.
But what does it say when you've got all these different brands that have emerged? Like
I don't
used
think
to be,
when Mr. Greenspan was in.
it used to be
we had
Fruit of the Loom and J.C. Penney and all those
You had
guys. But now
Hanes.
you got Hanes, Tommy Johns, Jockey, and they're all advertising too. If you notice that.
I don't. Well, you're bringing up the brands that when Greenspan was around. I mean, they're still around.
Yeah.
Hanes and like Hanes trades on the stock market, but they come up now with all this fancy,
Under
super
Armour.
fancy underwear. Tommy
Yeah.
John, Under Armour, right? So I don't know if this is as good of an indicator as when Greenspan used to. And I remember listening to Greenspan on TV when I first started, and they would talk about this underwear indicator, so that's why I was compelled to. But Danny is a terrible indicator for that and I am probably too, because I'm not going to buy them unless I absolutely need them, and I'm not really worried about the economic cycle.
Well, when you do a report on this, just publish it a brief.
I will. Danny's,
Yeah, this is interesting.
it's Danny's search history. You better
Yeah.
delete that when you leave. But what is it? Is there a new update to the underwear index, Danny?
Well, I couldn't. This is an old article. It's from May of this last year, but it goes a lot further, right? We always heard the lipstick indicator. They actually break down a lot of beauty products and like self-care things that you do at home. And I'm just shocked at actually the price of some of this stuff. Like men's grooming, the average price is $25.54.
For what?
Haircuts?
Yeah, I don't
stuff?
know.
Haircuts?
I'm not sure what. I need to go find and dig into the definition
Okay,
here.
there's
Well, let me know if
there's-
underwear confidence is rising. There's a
There's
joke
a
in
new
there
indicator,
somewhere.
too, a new category.
I was going to
of-
say something, but
of
I
men's
won't.
care.
There is.
Yes. I saw an ad on one of these monitors back here. Manscaping is a thing.
It is a thing.
Yeah.
It is a thing.
Huh.
Shave everything.
So the Manscape indicator.
There's a Manscaped indicator, but they're saying the underwear confidence is rising, the underwear indicator.
Yeah, this data only goes up to 15, from 05 to 15, and it looks like it was increasing, albeit rather slowly. I suppose that makes sense.
It's amazing this is really fancy economics. Well, again, I don't know. Just wanted to.
There's a Big Mac index.
Yes, there is the Big Mac index. And Greenspan always had his briefcase. Like we had the briefcase. If he had the briefcase or not, there was always an indicator. So there was all kinds of indicators that Greenspan spawned. That
The dry
everybody-
cleaning index.
The dry cleaning index. But again, nobody wears really clothes that get dry cleaned anymore, do they?
I mean, I wear,
I mean,
yeah.
but
Shirts.
not. I don't think in the same volume. People are not working in the office as much.
True.
So if
Yeah.
I'm wearing,
Yes.
and I'm not wearing a certain shirt and tie like I did.
I had that conversation this week with Michelle. I need to dry clean because I iron all our shirts. One, they last longer, and two, I'm not paying somebody $2 to iron a shirt.
Right.
But,
Yeah.
And you know it's done right.
but, man, there's many days, early mornings, it sure would be nice. Late nights, early mornings, they weren't together, man. It's tough sometimes.
Yeah.
Well,
So
isn't James tall enough to do that now?
child labor.
Yeah, I'm not sure I trust him with an iron quite
in
yet.
He came in here and punched all my buttons over the weekend, so I
He
figured
didn't, but he wanted to make you think he did.
Yeah, I don't think he really did.
that was hilarious.
I think he was giving you a little humor
Oh
there.
yeah,
That's
oh,
the
yeah.
rule. You
But it was
cannot
cu-
go in here.
But it was cute though.
I stick him in Connie's office.
Dear Brent,
I accidentally pushed all your buttons.
accidentally.
Accidentally.
Yeah, yeah.
Well, speaking of children, we're going to have a Raising Money Smart Kids coming up, Lunch and Learn, on February 23rd at noon. Now, we'll tell you, we're going to handle this in a very different way. We want to help you with tips, but we're going to be using the money scripts. Do your children have different emotional presets to how they treat money? Money avoidance, money worship, money status, money vigilance. And where do you fall on this? So we're going to talk about it, give you tips, games, books, different things to create conversation so that you can raise money smart kids. I will tell you basically that boomers are not really good with money when you look at the median retirement savings of just $144,000, Danny, when Americans are living longer. We know this story, right? I couldn't believe I actually heard Lance say on the radio the other day, Danny, you have clients that have 500,000 or clients that have 10 million. And one, because Lance is always telling you need like $30 bajillion to retire, but you may not. But we know one thing, $144,000 is not enough. Right? So that when you look at the Bureau of Labor Statistics, spending patterns among that of the baby boomer generation range between $48,000 $149,000 a year. So, Danny, it doesn't have to be so hopeless when it comes to that. Matter of fact, if you look at some of the other generations, like Gen Zs, they are, even though they're behind, they are savers. So we're seeing younger generations starting to put money away sooner. And also, here's the thing and I know you want to learn this from a Gen Z, but they spend less. They don't need as much stuff as a boomer, and they want to retire sooner.
Yeah,
even if they have to work odd jobs and do certain things, like they may still be active, but they don't. This whole career thing for them, I don't know. Generally speaking, is not.
And I think the pandemic may have had a big mind shift in thought as far as what people expected or when they wanted to retire. I mean, we know typically it was much later, but I'm hearing a lot more in financial plans, people saying, hey, 55 is the number. And that seems to be something that people are falling on more often than not as of recent.
Okay.
But yeah, so I love that because I think that, look, if it's going to encourage you and you're going to have a goal and it's going to encourage you to make good decisions all along the way, fantastic. Even if it doesn't come to fruition, because what I will tell you is that I have a lot of clients too that say, hey, it's going to be 55, but then they may retire for a bit, go back to work, or they just decide, you know what, I'm loving what I'm doing right now. I'm going to keep doing this.
Yeah, why not?
Until I can't.
Yeah, what you brought up the cool part. The cool part of someone that has done a financial plan, and I think that you have to do the plan to figure out what your lifestyle is going to look like, even if you're not happy with the results, because it shows that you need to catch up. And I will tell you, you don't use the risk in the market to catch up. That's not the way to do it. Okay, you don't you don't gamble in the casino. It's going to take some effort on your side, whether it's working longer, living smaller, really reassessing what makes you happy outside of money. And there are people that are doing it overall. So to your point, yes, there are clients that have done plans and they feel, I like what I do.
Yeah.
And there is this retirement clock. I will tell you, there's this internal retirement clock that people have when they are done. When they are totally done.
They know.
Their gut's going to tell them. But if they're making good money or they're working, they're doing consulting and they have flexible schedules and they're still bringing in cash flow to the household, even though they don't need to, it keeps them healthy and social. So obviously, there are many ways to try to make the most if you haven't saved enough for retirement. And one of those things is to make a good decision with Social Security. How and when you take it will matter. Working longer will matter. Downsize the scaling of what you were thinking about doing in retirement, replacing certain hobbies that are not as expensive with hobbies that you wanted to do. That doesn't mean you're unhappy, but $144,000 as median retirement savings, right? When life expectancy has been increasing, is not a good mix. Also might need that you may need more guaranteed income to supplement your Social Security so that you don't outlive your money. All right, we'll be back here on Financial Fitness Friday. Stay tuned.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
We teach our kids the alphabet and all the colors too. But raising our kids to be money smart is really up to you. Our next RIA Lunch and Learn will dwell upon this topic, because teaching kids to manage their coins puts money in their pockets. Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
See, there you go on Fox right now. Otters are becoming artists for Valentine's Day. They put ink on the otter's feet and let them run around on paper, and then they make an ottergram out of it. Don't ask me why.
My puppy does that with poop.
You just keep that story to yourself.
The Real Investment Show podcast. Same show, your schedule.
You know what, though? They're going to make millions off that.
Yeah, they will.
Because happy extortion day.
At realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And we are back. Welcome to Financial Fitness Friday. Mr. Ratliff, Rich Rosso, we're here to give you the scoop on things. Although Dow futures 159 points down, S&P futures down 28. I think the Fed is starting to spook things up. Aren't we waiting for, we got housing starts today. We've got PPI final demand for January. Initial jobless claims. Philly Fed index. So we've got some data today. We'll see how it all transpires. But obviously the Fed, based on these numbers, inflation numbers, and retail sales, however you slice it, pretty strong. I understand when you got to look at real versus nominal, people are spending more for less goods, but people are spending. And they are spending on services, and they're going out. So, Danny, there's this fever still, and I understand numbers get revised, but these are not the numbers we would expect to see at this point of Fed tightening, and that means perhaps the market needs to price in 50 basis points on the next move. I don't think you can discount that at all. Do you?
No, I don't think that's out of the question. And this week, we're getting a pretty good preview as far as what the Fed's thinking. They're trying to telegraph this as much as possible. I mean, we've had a lot of Fed speakers come out. Today, we have President Barkin, Richmond Fed Chair, Fed Governor Bowman speaks. I've got to think that they're going to reiterate probably what Bullard said, even if they don't do it, just to bring this thing back to reality in some way. And look, I mean, we can make that argument, and we have these discussions, especially when people are asking, they're concerned, and we are too, about where this thing is going. I mean, there's quite a conundrum going on from a technical and fundamental perspective. And in this environment, we have to be cautious because the market is looking out ahead of the economy. So we also have to remember that most of this information we're getting, number one, it's in the rearview mirror. Number two, it's likely going to be revised at some point. And at that point, how much does it matter? Mm-hmm. Once you get that revision in, 6 months down the road?
Market doesn't care.
Yeah, at that point, we're so far past it at that point, we're going to say, well, yep, it's what we thought. Or maybe it's different. But yeah, I could see them certainly coming out being a little bit more aggressive here. I don't think that the thesis has changed, however, in the sense that at some point it's going to be detrimental, right? We're still waiting for a lot of this to really flow through to the economy. These higher rates, these rate hikes they've been doing. I mean, we also have to remember that this has been one of the fastest rate hiking expeditions that they've gone on. I mean, this has not been, and they were so far behind the curve.
Well, then the velocity of the move, yeah.
Correct. They didn't have the opportunity to slowly do this. And, you know, we can make an argument that this was mishandled from a monetary policy issue. I mean, fiscal policy. We could make a lot of arguments here. But we are where we are for a number of reasons. What they're going to do about it is I think they're going to have to go a little bit longer. But I still do believe that they're going to stall. They're going to cut. It just may not be as quick as what the market was hoping.
Yeah, I don't, and again, anything could happen here, but I don't see a pivot by the end of the year. I don't see the Fed coming out there and cutting rates so quickly.
Yeah, and I don't think they're going to get substantially higher. I mean, we are seeing inflation come down. It's just not as quick as what the market was expecting.
And I don't know what takes down the service inflation.
Yeah, I don't know either.
I mean, it just seems that people want to spend, and I don't see how you, as a business, you still don't have enough leverage to maybe pay people less. And if you've already raised the bar to pay them, you're not going to take the money back. Food costs are still high, right? So these costs have to be passed down to us. So I don't really know with many businesses how this service inflation gets worked out. So I think the Fed's going to have to move maybe bigger, maybe for longer. Maybe they still keep it at 25 basis points, but there are just more rate hikes that they're going to continue to do. But it's like you said, it's not because of what happened post-pandemic and employment. It's going to be a challenge to see how much of this it's going to take to pull some of that inflation and sort of tilt the leverage back to the employer from the employee. And I think in some businesses you have seen it. But in most service businesses that we talk to and what we read, that's not the case yet. That's not the case.
I think right now executives and small business owners are really facing an issue in the sense of trying to plan for 2023 has been extremely difficult.
Yes, it absolutely has.
You know, last year we can argue that we had a perfect storm in so many ways. I mean, you look at all the headwinds that we had to face, multiple just kind of coming together all at once. And, the likelihood is there's going to be some things that we finally have behind us. But I think that the main issue at the moment is the Fed.
It is. And if this market can just trade in a range, in some ways it feels like it wants to go higher, right? It looks resilient later in the day. It's bad news, but it looks measured on the downside. Like everybody doesn't want to miss out. I think you still have this fear of missing out.
Yeah, volume and timing has really been interesting in this
think
market.
So.
Looking at it on a day-to-day basis, right? You're getting a sell-off in the morning. It gets a little bit better throughout the day.
Yep.
Buyers are coming back into the market. So do you make the argument we haven't seen capitulation yet?
No, we haven't.
I thought at a couple points maybe we had, but now I'm not so sure.
Yeah. So I don't know what's worse. I don't know if a contraction is worse than a stagflation, recession, whatever name you want to put, the muck. I don't know if with all the debt we've taken on and the debt service, and it's not just us, it's across the globe, that portends to lower productivity, lower growth. We spend all this money to get 1.5% growth. It doesn't make sense. We're not anywhere near long-term averages. So, and again, it's not just us. that's in this muck. So I don't know what takes us out of it, and that's going to be a frustrating experience for investors. So you have to try to focus on what you can control. You can control how much risk. You can control how much you save. You can control how much you manage the cost of your household. There is so much more you can control than you can't, although sometimes it doesn't feel that way when you're an investor because you're focused so much on the portfolio and what positions are doing, but you're not stepping back and looking at all the things that you can control. Hey, listen, I've talked to some people even with the portfolio. They're like, you know what? I'm gonna stay underweight in stocks. I understand may not be a recession this year, but I'm comfortable because of the risk I'm willing to take right now. So I'm not out of the market, which is great. We tell people don't do the all in, all out. I'm not out, but I used to be at 70, 80%. I feel more comfortable now at 40 to 50. And I'm like, listen, if that prevents you from trying to time markets, yet you're still participating. And what we're noticing, Danny, and I've looked at the charts yesterday, we are seeing this break in connection or correlations between stocks and bonds. Now, I don't know. With some of the numbers coming out, maybe stocks and bonds move together again like they did last year. But for the most part, through this year so far, stocks and bonds are delinked. That's been important. I don't know. Again, if these numbers continue to be hot, maybe yields go up, bond prices fall, and stock prices fall. So we're going to have to wait and see how if that real connection we saw last year that made the 60-40 portfolio make you want to puke will be the same this year.
All right, so end of last year, a lot of pundits coming out and economists saying, hey, 60-40 is now still in vogue, but you switch to 60 and the 40, right? 60 is not stocks to bonds. The 60 is bonds to stocks.
Correct. I think Goldman even said, some of the big houses were talking about that, right?
And I think that argument's not dead.
No, I don't. I mean, because the intention is to slow down the economy. It's just been obstinate, right? But it is the goal. And if that's correct, then intermediate long-term yields should continue to fall. And matter of fact, there are a lot of people buying treasuries, and that's great. 4.7%, 3 to 6 months, no brainer, right? I'm not taking any risk. I get my money back. If I'm a saver, I don't have this financial repression over me where I'm just giving money to the government. I'm getting nothing back. I'm getting something. But what about, especially if you're buying individual bonds, you go out a little bit on the yield curve thinking that the Fed is going to hit their objective. They are going to slow growth. Well, we can argue about hard landing or soft landing because the money's on the soft landing. But what if I laddered out a little bit longer on the curve, thinking that eventually that longer end is going to continue to fall because that's a function of inflation and that is a function of economic growth. And if I do think I'm going to be into a disinflation mode and longer term rates are going to continue to fall, now if I go out and I'm not talking about going out 20, 30 years, I'm talking about what if I ladder bonds out 7 or 8 years? Maybe I'm getting 5.5, and I know maybe I'm getting as good on the short term, but I'm expecting that. I don't think there's anything wrong with that in your bond ladder.
No, I don't think so. Had a conversation with a client yesterday and exactly that. And said, listen, I love these 3 to 6 month yields. And we were talking about 4.78 to 5% this morning. But I know that's for only a short period of time, likely. And I do believe that this plays out. I like the flexibility, put money back into stocks, but I also think that I can go out a little bit longer on the yield curve, lock these rates in, even if I don't catch the top.
Yep.
Have that appreciation, and then still have the flexibility to put back in equities.
Yeah, makes sense.
And he's still in equities, by the way. But just thinking it out, thinking a little bit differently about it.
Absolutely. Got to try to stay a step ahead. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We teach our kids the alphabet and all the colors too. But raising our kids to be money smart is really up to you. Our next RIA Lunch and Learn will dwell upon this topic, because teaching kids to manage their coins puts money in their pockets. Join Ratliff and Rosso February 23rd for the How to Raise Money Smart Kids Lunch and Learn. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back. So we recently did a Candid Coffee on financial infidelity, and it was really, not to be nefarious, I know it sounds bad, but it's just about how you can be money aware for each other. Everybody's got a different money script, money language. Hopefully you get that settled out before you get married, but you want to have this discussion around how money is being spent. So, Danny, that was a pretty good, I think, set of tips we have given everybody. I think that is up on the YouTube channel. Now, you all may not be interested in that, but you may have children that have just gotten married, about to get married, that they should really look to these. We give you some ideas of how each spouse should talk to each other, boundaries around spending, communication around spending. Very important. So I think, I really like those tips. I think setting boundaries on how much you're going to spend outside of each other's joint account, your joint expenses makes a lot of sense, right? The discretionary fund stuff that you might have in your, not an allowance, that's a terrible word to say, but hey, maybe I can spend $50 to $100 on myself, and I don't have to really let my spouse know because we've agreed upon this. Right? How do you all do it? Me and the dogs have this discussion. They just keep wanting me to spend on bones. So
Treats.
treats and treats.
Yeah.
That's all they care about.
Well, I think each family's probably, I know it's different. We see it frequently, and I think you need to get that. Where is it that you feel comfortable? And with our household, it's a tad bit different in some ways, right? Because Michelle has the authority that if she needs to, it's a necessity. Mm-hmm. She can go make a big decision because we're working a lot right now, right?
But you categorize it as this is a necessity, right? This is something that's absolutely required. This is not a discretionary thing. This is important, right? This is a big thing that is needed by the kids, right?
Correct.
But you also have very similar money virtue. In other words, you both think alike about money. It's not like one's a spender, one is a saver. You're aligned.
Yeah.
I think it makes it easier for you to do that because you are aligned.
I'm more prone to spend than she is.
Yeah. Wow.
Yeah. No, that's the truth of it. She she's extremely frugal, and I am so blessed with it. And
It's good to have that.
by seeing
Yep.
this, and I think this makes marriage a lot easier as well. But we do have these conversations. I think that's extremely important to make sure that you're on the same page. You're having some types of meetings that there's a good understanding of what goes on, and there's so many different reasons, right? I mean, one, we talk about the financial infidelity that a lot of people have, and the risk that it puts people into. As a household, I mean, you hear some horror stories.
Terrible stories, yeah.
About people just making dumb moves or going, hey, and even from an investment standpoint, I think you could take it even deeper, Rich, where you may have a spouse who has a very high risk appetite and is willing to put all the chips into the middle of the table
Yep.
on something that's extremely speculative, which we see that cause major issues as well. But
It does.
The main thing historically, though, is just spending. And how do you set those parameters? And is it that it's $100? Is it $400 or $500? It's going to vary for each household depending on income, overall debt, net worth. Some households it's much higher.
It is. It just depends. And like you said, it depends too on knowing each other's money personalities. And the only way you and Michelle know that is you discuss this stuff. And I think a lot of the younger generations, even some of the younger boomers, are aligned to do that. I mean, when I meet with younger couples, they both are involved. I love that. A lot of the older boomers, it's a little different. There's always one party that seems to be more interested. And I have to be the one that says, listen, I understand your husband or your wife are not handling the finances. We're not coming up with these decisions to select a financial advisor or how to manage money, but they need to talk to us. They need to know who we are and what we do and talk to them in their language of what it's important to them outside of the money, and that if something happened to you, they know who we are.
Well,
so
I
there's
think
got to be
that's-
some level of engagement.
I think that's really important, right? So we do find that there's a lot more comfortable people. Obviously, you've had more experience. You've understood where your roles are in the household. What one person may do one thing, and I find that a lot of times they are more confident in many ways. But the problem is, and look, let's face it, we're blessed in the sense that we're not dealing with the average household that it's only saved $140,000, right? So it's a little bit different in that aspect. So
well,
maybe
in some cases we have, but they're
skewed-
younger.
Yeah.
They're younger and they're good savers. But
Correct.
to your point, yeah.
But, and I'm talking more of the older generations here, but I think that the big thing that you just mentioned is a lot of times there's just no idea where the funds are, what they're doing, how they're operating. And many times funds are spread out in multiple areas. And if something, God forbid, happened to this person who's typically handling it, the other person would have no clue. And
Right.
that's where they get in trouble when somebody becomes incapacitated, somebody dies. Big issues, right?
Yes.
And then, we see many problems that are associated with that. And not only just, where are the funds and how do you access them? Are you even on the account? Are there beneficiaries set up? I mean, these are simple things.
They are, but to have the time to set aside.
Where's the online presence?
Yeah.
That's a big one.
That is a big one. That's a very big one. So interesting. I was on years ago when I first started working on Fox and Channel and KPRC and all that. They had me on to discuss dating tips, dating financial things. Like if you're dating, what kind of questions you ask. And I'm like, listen, you're asking for trouble here. Like I'm a money guy. Like, it's not, no, we want it from a financial perspective. I said, okay. So I'm on this panel. And they said, okay, Rich, what questions would you ask? Maybe not on a first date, but a second date. And I said, what's your credit score?
Oh, you're getting deep quick.
And, well, in other words, I don't even
will you
want-
please fill out this application?
Yeah, listen. And,
You've made it past the first test.
okay. I was validated yesterday. I'm going to get to that point.
You get to go to round 2.
But everybody's like, what? How dare you? I'm like, a good credit score tells you a lot about a person's fiscal responsibility and their discipline for delayed gratification, right? Good fiscal habits. And if that doesn't, and listen, I'm happy to share my credit scores too. So I also brought that up after I got yelled at. I'm not hiding mine. Show me yours. We're going to show each other stuff on the second date, but it's not what you think. It's credit scores. So yesterday I read a story about a girl who I guess there's a service called Hinge, like Tinder or whatever. She gets more dates. You know how she gets the dates? And she's a very attractive young woman. But do you know how she gets dates?
No.
She posts her credit score. She puts her credit score on her profile. And I thought that was genius. She attracts guys that, when she dates, that say, this is great. I love the fact that you're so responsible. So in other words,
it's fantastic.
So she's actually getting a lot more dates and it's not like she's putting out her social security number. Come on. It's not like, because people were telling me years ago, oh, that's so confidential. No, it's not.
She better be careful. They may be looking for a sugar mama, right?
Right.
Like,
That's another thing she's got. She's got to be careful because, oh, man, I can't wait to wreck that score, baby. So I'm going to score all right, but not what you think.
Man.
I'm going to take that credit score down to 500. So, but for the most important part is she's attracting a different quality of date because maybe the other person on the other side doesn't really want to bring that question up. So she gets it out, and then the guys are willing to share, hey, I'm really good with money too. And I think when you're first starting out, you better be aligned.
Well, that's really
so
nice.
I thought that was a genius story. I thought that was a great idea.
It's a good way to get that front and center without coming out with your application. You made it to round 2, and I like that, right? Because you're getting it out front and center. You're going to have those discussions probably pretty early on in the relationship and determine if this is something that you'd want to do moving forward.
Listen, life happens, and credit scores can get dinged for all kinds of reasons. But generally speaking, I think having a good credit score says a lot about who you are.
Yeah.
Your responsibilities, right? You have. What are you going to say?
Well,
there,
the
Mr.
next reality show could be FICO Island.
There you go. I like it.
I would watch that one.
Trademark it.
Yeah. Just saying.
Well, but I mean, I probably different than most just from what we do, but I can remember dating a young lady for a minute, and she was very attractive. I thought very smart, but she couldn't balance a checkbook.
Well, lots of kids can't do that.
Well, I know. I mean, this is early 20s, but at the same token, it was a major red flag for me, and I was like,
Yeah.
That says a lot.
And
While
hold
you're
on,
aware
and then
of
you
your
start
money.
looking like, hey, hold on, you bought this, this, and this, and you're doing. Wait a second, this isn't going to add up. This is not going to work.
Mm-hmm.
But not to switch gears too much.
What?
You mentioned earlier. You said,
go ahead.
What's the magic number for somebody to say, okay, without having to discuss with your partner, your spouse, I'm going to spend $100.
Oh, you mean on my own?
Yeah.
Discretionary fun stuff money.
But the other problem that I think people run into is the frequency of that. So some people may say, well, $100, shoot, I do $100 a day or $100 a week.
Oh, no, that's a good point.
So you need to have that conversation too. Like, hey, hold on here.
Hey, not $100 a day, buddy.
Yeah.
What are you doing over there? Right?
Correct.
So I just help you guys out for dating this weekend. All right? I'm helping you to score. Credit-wise, that is. So raising money of smart kids. Sign up for that. Lance's Daily Commentary. Check out our YouTube channel. Check out the Financial Infidelity. Pass it on. You might be Fidelity. Pass it on to people who might need the help. We appreciate you. Have a good weekend, everybody. Thanks for tuning in.